Welcome to the Money to the Masses podcast, putting you in control of your finances. It's a good thing podcasts are free, as this one isn't worth a penny. Here are your hosts, Damien Fahy and Andy Leeks.
Now, Damien, before we get on with this week's podcast, you had something quickly to say about our sponsors.
Yeah, we've got a new sponsor, Money Farm, and Money Farm are an online investment advisor and one of the biggest digital wealth management companies in Europe. So a big thank you to them for sponsoring the podcast. Now, Money Farm create portfolios to maximise long-term returns using ETFs to make incredibly cheap portfolios. And you even get the first £10,000 of your portfolio invested without any charge from Money Farm. And if you enter the code MTTM20K into the box when you sign up, you get the first £20,000 of your portfolio invested and run by moneyfarm.com without any charge.
Great stuff. On with this week's show. Hello and welcome to episode 111 of the Money to the Masses podcast with your resident expert, as always, Damien Fahy, and me, Andy Leeks. Damien, welcome back. Good to see you. You look like you're in a different place.
Well, I am in a slightly different place, so excuse if I sound slightly echoey, but in the building next door there's a bit of work, I think, going on, so I was worried that I'd be doing a podcast and you guys would be having heavy drilling every now and then. I don't think they're going to be drilling that much, but just as I was about to start, there was a rumble, and I thought, oh no, do you know what? Let's just move location. I can actually hear it now. I'm not sure if the podcast can pick it up. If you can, it's not thunder. Just ignore it.
Good. Well, it's good to see you again. How you been doing in the last week?
Yeah, good actually. We're doing. Do you know, one of the things we launched a new social media angle, which I'm excited about. Every week we're always trying to push boundaries, and we've just launched a new feature on YouTube. We've not really done YouTube properly. Our podcast goes on there just so people can listen, so different ways to consume the same material, but we're now doing a video series called Ask Damien Fahy. So it's a hashtag Ask Damien Fahy, and you go on there and it's me in about sort of 90 seconds, 2 minutes, where I answer a series of quick-fire questions about money. So the first episode went live this week and proved popular. We had about 1,000 views in the first 24 hours. And so, yeah, it's going to be really good. It's got music overlaid, me talking, being just like the podcast, like natural, but it's just about questions that people ask. Because we get asked questions all the time, and it's quite hard to put them all down in an email, and sometimes actually to use social media to get the word out to more people. Because the one thing I've learned from Money to the Masses, which is why it's been able to be successful, is that if one person asks a question, that normally means there's about 1,000 others wanting to know the same thing. So if you put it out there in terms of content, whether it's written or podcast or social media, then that allows you to help more people and then gain bigger influence and more eyeballs or ears listening.
Good. I've seen it myself, and I thought it was really good. I shared it and did all the necessary. What I love about it as well is if you've included the text on the screen, which is the done thing these days. Because obviously people listen on devices. They might be listening to music, and it scrolls up on their feed. They can still get a feel for what's going on, even if they're not necessarily listening to the content that you're delivering through your mouth. They can still read what's going on, and that's really clever. And I think you've done a really good thing to include that with the latest videos.
Cheers. And one of the things, it's deliberately short. People might want to wonder why I've done it so short. It's because really, for something like that, which is visual, people, it's been shown that people only listen to up to 90 seconds. You've got 90% retention rate of people's attention. Podcasts like we're doing is different because people listen to the show regularly and hear us conversing and what we're talking about. But something like that appears on social media, don't forget people on social media are just flicking. They like something or they just move on, they move on, they move on. It's a very different way of consuming, so that's why it's short and punchy. So yeah, go and have a look at it. It's on Facebook, it's on YouTube, and it's on Twitter. And while I talk about social media, one other thing for people to go and look at, you may have heard me, I do occasionally mention about Crohn's and Crohn's disease and the fact that I suffer from it. But actually this week is Crohn's Awareness Week, and I think it's one of those things that it's not about me and what worries me or anything like that. There's far worse things in the world to have than Crohn's, but go and have a look on social media, on Facebook. You'll see that the Crohn's and Colitis Society did a campaign where you could put in your details and create a poster about your story to try and spread the word about it, because people don't understand what Crohn's is and the pain and things people go through. So I did it, and you can see it on there. And so I wouldn't be, if it's Crohn's and Colitis Awareness Week and suffering from Crohn's and doing a regular show and an audience, I felt I would be doing a disservice if I didn't raise awareness and mention it. So go and have a look at it, and even if you just find out what Crohn's or colitis is, most people know somebody who suffers from it, whether they realise it or not. So I just wanted to quickly shout out about that. I'll move on, but just go and have a look, please do.
Yeah, do go and do that, because I know Damien and Justin, his brother, very well, and both of them suffer, and I tell you what, they never ever moan about it, and the things that they have to go through, won't go through it on podcasts, it's personal to Damien anyway, check out the poster, but the things they've gone through, and they never, and I learned something new just by looking at that poster that I didn't know about Damien, and we talk almost daily, so it was well worth doing, and it was an eye-opener. Good stuff. Okay, moving on. What we got on the pod?
Right, on the pod we've got logbook loans. I want to talk about something to be watching out for, and we've got two investment-focused pieces. One is about something that's called Alpha, but I promised it last week. You probably forgot, Andy. I said to you remind me, but one about Alpha, and there's also a piece on. I've got a really interesting question about what happens when you get towards retirement in terms of trying to derive income from your investment. So I want to go over that. So I will start, I think, with the quick fire. I'll go with the logbook loan angle. Actually, before I start that, deviating slightly, it was quite interesting this week because there was a story about the £5 notes. Did you see that?
I did. Is it to do with vegetarians or vegans?
Yeah, it had tallow in it, the stuff that's derived from an animal product, and they were all up in arms about it. Which, I mean, understandably, if you've got your own reasons why you don't want to use a product or that has that in it, and it could be religious or whatever. But I did see somebody do some analysis about how many cows would actually die in order to produce all those £5 notes, and it actually equated to less than one. Less than one to produce that? Well, they worked out the amount of, because it's got a trace of tallow in it. That means that it's so small. When they did the calculations, it was a slightly finger in the air calculation, so I wouldn't bet your mortgage on it. But the point was that the amusing angle, depending on how much truth is in it, but that people are putting 100,000 signatures to save effectively one cow on the government.gov website where you can actually sign petitions. Yet there's others on there that do with culling badgers and other animal cruelty that have far less signatures that would save far more animals. But each to their own. But I just thought I'd mention it because it's just in my way, it's just quite vaguely amusing. But also, what it does do is it highlights how newspapers jump on a topic and then they fan the flames of something without really checking all the details. So we talk about in the podcast about always trying to look through a story, and that's another good example. But yeah, anyway, moving back on to what I was going to talk about, logbook loans. Do you know what they are, Andy?
No, I've got no idea. So you're educating me.
Right, a logbook loan is if you secure a loan on a car. So obviously a car logbook is where the name comes from, and some people will need money, and so they'll use their car as security. And the term logbook loan isn't this sort of official term. That's what the phrase that's coined for them. But the problem is that people are selling on cars where they've got a logbook loan on them. And technically, you shouldn't do that because you don't own or have full ownership of a car if there's a debt still placed upon it. Now, the problem comes is that there are people, and there's apparently about 50 cars a year that this happens to. There are people who buy a car that has a loan on it, and they are unaware because how can you tell? We can't tell by looking at a car. And that loan, therefore, is still on that car, and the creditors actually have a claim on that car. And 50 people a year, or 50 cars, are being seized after they've been bought by somebody privately. So it's definitely something to watch out for, because somebody might have a loan on a car. You might go and choose a second-hand car, buy it privately. The person may have a loan on it. They disappear off into the sunset with your money. Then some point later, you'll get a bailiff come round who will then actually seize your car and off they go with it. And they're actually entitled to under something called the Bills of Sales Act. And there's lots of talk about trying to change the law to stop them being able to do this. But when I was looking into it, doing the research, this has actually been talked about for years and the law hasn't changed. So The point of this short piece is that 2/3 of people do not check if there's a loan outstanding on a car when they privately buy it. So you need to check if you're going to go and look for a car this weekend or in the future. Check to see if there's any outstanding credit. Now, how you do that is there are companies like the AA and the RAC do it. Now, the AA do it, but you have to pay. So it costs you about £20. But then that's far better than having a car being seized and taken away, you having to unravel and chase somebody for the debt. Because despite the fact that some people tell these claims companies where the person is who owes money on the loan, they still just take the car to be able to clear the debt. So, logbook loans, be wary of logbook loans and do check with the likes of the RAC and the AA when you do go and do other checks on the car.
Good stuff, really sensible advice. I take it if you buy from a dealership, albeit even if it's just a really small dealership, you're pretty much protected. Is that right?
Yeah, but the thing is, they should have checked. If you buy from a dealership, there's different protections anyway, because some of them give you guarantees, you can buy them, but they should have checked all these things anyway.
On your behalf?
Yeah, and you can actually ask them about that, because part of when I bought a car, I bought it from a dealership, and therefore it was a car that had been trading when someone was buying a new car. So there's lots of these checks are done, but I would still always do these checks. Ask them if it has been checked, and if it hasn't, and they haven't got the evidence, then you're going to have to do it yourself. So prevention is better than cure, and you're always better off doing your own checks.
Good stuff. So this is something you mentioned in the pod last week. We're making sure that we deliver it the very following week, rather than tradition and sort of wait 4 or 5 weeks before we go over old podcasts and then realise that we haven't done it. So investment alpha, is that right?
Yeah, it's right, Andy. Yeah, because anybody who didn't listen to last week's show, I promised previously to do a piece on holiday tips. And it took me about a month to realise I'd not done it. And in the meantime, nobody wrote in and pulled me up on it. So yes, I blame the listeners as much as myself. But yeah, alpha is one of these interesting things. I got asked the question by somebody and said, "Where's all the alpha gone? Is it actually any point trying to run your own money and outperform trackers?" Now, alpha, if you run an investment portfolio, whether it's funds, shares, or whatever it is, there's something they call alpha, which is basically a fund's excess return relative to a benchmark or an index, okay? So it's like that kicker, that thing that you're doing. So if you're a football manager, it's the thing that when you take over, you've got the players and you've got that extra bit out of them, that alpha. And it's a figure that's often bandied around because it makes you sound quite intelligent. You see fund managers talk about the alpha they add, but it is a legitimate statistic. Now, somebody asked me, given this period of time, they didn't feel there was any alpha out there that you could get, and would it be better off just bunging their money in an index tracker? And question is relevant for any time period. So that's why I'm not relating to what's going on in the market right now. This is the whole point. It's evergreen. Alpha is one of those things. So that excess return is something that is tied very much to the time frame you use. So I want to give an example. If you imagine there's a fund manager, he could have been a legend. He could have outperformed, but it'll be a period where he won't outperform. So he'll underperform his benchmark or his peers. So therefore, if you do this statistical measure of the excess return, that kicker he's giving, that genius, as it were, he was adding, then he could actually be negative. So he isn't adding anything. So you'd be right, go, there's no alpha. I mean, this guy is a waste of time, or this process that I'm using to pick a portfolio. The problem is if you extended that period and looked over, say, maybe 2, 3, 4, 5 years, then it could be alpha. So if you do the statistics, you can see that excess gain. And the point is, the additional return, that kicker, is not a universal constant. It doesn't get applied at the same rate. So if you compare your portfolio out there, you may be running money yourself and doing your own DIY investments, and you will probably underperform a benchmark that you're tracking for a period of time. If you don't, then you are either a genius or perhaps lucky, I don't know, because you are going to underperform, because trackers will, in certain conditions, perform quite well because they're very responsive to markets, upticks and downticks. So if a market suddenly rallies, the index they're tracking, then they'll obviously jump. Of course, in your own portfolio, you may take more concentrated bets on things, and that will add your alpha, therefore you outperform that index. But there will be periods of time where you will underperform, and there will be periods of time where you will outperform. And it may be that you enter the market at just about the wrong time when things all sell off, so no matter what you would have bought, you probably wouldn't outperform most of your peers, if that makes sense, because you've got in at the wrong time. But if you stick to a process, then that takes out the emotion from investing, then you should be able to find that alpha, that measure of being the excess return. Now, 80/20 Investor is the DIY investment service that I run for people, and this is where the question originally came from. And over a long period of time, there will be plenty of alpha. And somebody asked me that and said, should I just buy one of the equity index trackers? The problem is that if you compare a portfolio of funds that are in a mixture of equities and more safer investments, maybe like bonds or whatever, then you're not comparing like with like. It's apples and pears, if that makes sense, because you need to pick the right benchmark. So the time frame and the benchmark are important to be able to assess what alpha you're adding. So someone might say, well, if I tracker, why don't I just buy a tracker that just tracks all the global indices of equities, like a broad mix? Well, the thing is, that's 100% equities, and that's very risky, whereas you might be running a portfolio of funds that has a mixture that has only half the amount of equity exposure. So you need to make sure you're comparing like with like when you're trying to see if you're adding value or you're getting value, even from your financial advisor or any investments that you own. So alpha is important, but it isn't a constant, and there will be periods where you will outperform and there will be periods where you will underperform. And if you're one of these people who doesn't like the idea of trying to generate your own alpha, trying to maximize your returns, then by all means you might want to buy an index tracker of some kind, like the Vanguard ones that are out there. But you will only ever get what the market does, which might be fine. But as long as you keep costs low, trust me, we wouldn't be doing this if it wasn't possible. And that's the reason that the whole 80/20 investor idea is being built upon, and the algorithm is that no one fund manager will generate alpha all the time. Even the apparent greats like Neil Woodford, they don't. But there will be periods of time where they do outperform, so they're alpha, or there are periods where they underperform, so they don't have the alpha. What you want to do is try and move to the ones when they are outperforming, when every dog has its day. So you're kind of alpha chasing in a way. And that is the way that I tend to run money. But it's just the point is alphas, it is out there, it is possible. But the other thing is you need to have a long time frame, because if you focus on 1 year, 2 year, then you might not always get it because what the market's doing. It depends on your slot. And I could have very easily turned around to the person who asked me the question and said, look, this is what my £50,000 portfolio that I run has done. This is what everybody else in the trackers have done. There's your alpha. That's the bit I've outperformed by. But that's very simplistic, and it doesn't do the question justice, because there will be periods where, theoretically, I will underperform in certain periods other fund managers, that makes sense. So it's always about moving around, and over the long term, that should see you through.
Okay, so we've got a question next. Damien.
Right, this came from Phil, actually. And Phil's actually suggested 1 or 2 topics before. And so always write in and suggest topics, because people don't realise that I do read all the emails I get, and it does influence what I'll talk about. And Phil has written in, he said, "Hi Damien, loving your podcast." I had to get that bit in. "Loving your podcast. You're doing great work, and I'm really looking forward to each new offering. Can I suggest a topic? While a lot of media is focused on developing growth, there appears less information for the baby boomers who may be planning for retirement, either phased or full. After all, it will come to all of us sooner or later. My research points towards aiming for growth rather than purely investing in income funds, especially as the latter limits diversification options and also dividend yields tend to be falling. Given that sustainability is paramount for these people, what is your view? Best wishes, Phil." Right, that's a very good question. What Phil, he did send me a second email to clarify slightly what he was getting at. What happens is we all build a big pool of money, don't we? We all start trying to save. Well, I say we all do. If we can, we start building up a pot of money. And the idea is you get to retirement and then you're going to draw an income from it. However you do it, whether it's funds, investing, or ISAs, pensions. And you've got to work out how to turn it into an income. Now, in days gone by, people used to have a pension and they used to have to buy an annuity. So you get your lump sum of money, go to an insurance company, say, "Here's my pot of money." They sort of wave as they disappear off into the sunset with it, and then give you a steady income until you die. And it was never, the odds really weren't stacked in your favour unless you lived for a very long time, and then it was good value for money. Now that changed. And of course, people now have more of an option. They've got a flexibility. They can take chunks of their pension, or they've got more ways of managing it. So one way of taking money from a pension pot is you could live off the income that it naturally produces, or you could encash chunks of it. and go for growth, or you could do the third and go for a bit of both. Now, my view on it is, if you imagine a pot of money that's got to provide you an income, and if it's linked to the stock market, now at the moment we're going through an interesting period because Donald Trump caused the markets to throw a bit of a spanner. Whenever you listen to this podcast, there's always going to be a spanner that's thrown into the works that causes markets to either tail off or rocket. And depending on what assets you buy, then it will depend on whether you're doing well or badly. At the moment, it seems to be most things are doing pretty badly, especially bonds, which are the things that older investors will tend to buy because they're supposed to be safe. But nothing is safe in investing. The problem is, if you sit there and imagine you had £100,000 and you wanted to derive £5,000 income a year, so that's 5%. That's pretty punchy, to be honest. But if you wanted to do that, now if you encashed £5,000 every year, the problem is that you might have a year you make 5%. So it goes up to 105,000. You then take your £5,000, happy days. And if you did that every year, your pot would stay roughly the same. Yeah, inflation would knock it down a bit in real terms, what you can buy. But you'd hope you make a little bit more than the 5% you need, and you'd all be happy. The problem is, just like that alpha I was talking about in the previous section, returns on investments aren't uniform. And I know that the long-term average for equities is 5%, but it doesn't work like that. Because what will happen is, just like at the moment, markets will tail off. And even if it's with bonds, they will tail off. And you could get to the point where markets fall 10%. So suddenly, your pot fell to 90 grand overnight. And then you need to take your £5,000. You do that, you're down to 85. And suddenly, even if the market bounces back up again, you're going to not be back at that 100 grand mark if the market's rally. Because don't forget, if something falls 50%, then it's got to grow 100% to be back to where it was. It's just mathematics. So it's almost harder to recover those losses. So what happens is you end up eroding your capital much quicker because you're taking a fixed chunk from an ever decreasing pile. So actually it means that you'll end up, when it goes back, that you're not going to be able to afford. You're not, basically, in the long run, you will run out of money. So the alternative strategy is that you get something that can produce a natural income. Now, one way of doing it is to buy something called equity income funds that Phil mentions, and they may produce, let's dream and say they produce 5%. Then what happens is that the fund will produce, they'll invest in companies that pay dividends, and they will pay a dividend based on what the company's results are and how well they're doing. So that steady stream of income will come every year, but the size of the portfolio may move up and down with the share price, because dividends are paid in pounds and pence. They're not paid as a percentage of the share price. So what will happen is that 5,000 it produces should, if it's well managed by all those fund managers in your portfolio, remain fairly constant. And the key is to try and find those funds that actually pay reliable dividends. They don't get cut. They invest in companies that each year grow the dividend. And on 80/20 Investor, we do a whole research around this and find those funds that pay reliable dividends. So if you paid out that 5% every year, it doesn't matter if the market falls 50%, because assuming that the company can still deliver its products, it can still make its clothes or whatever they are, and people still buy them, they're still going to be profitable and they'll pay out dividends. And therefore, that is like a steady stream that as it moves and changes shape. I remember hearing one analogy once, which isn't perfect, but somebody said, if you imagine the equity income thing, it's a bit like a heart that's changing shape, pumping up and down, and that's as the share price goes up and down, but it's still got that steady stream coming out of blood that's going around your body. And that's kind of what equity income does. Problem is, you don't have a lot of control over the levels of the income, because if you're in a period where they start to fall, then obviously that your income stream may fall. But you've got to try and find reliable dividends. So what's my view on it? I think realistically the latter is the better option. I think it's quite difficult to achieve realistically, so I think you're probably going to do a mixture of both. I think you're going to have to go for growth, and you're probably going to have to do a bit of income, just naturally. I think that's going to be the case. But the one tip I would say is try and build a pool of money that you can keep as a reservoir, which you take your income from, and then that is topped up by your investments. So if the market falls, you're not encashing stuff at the point where it falls. Do you see what I mean? Your portfolio has time to move up and down, and you're not taking chunks at the wrong time. You can actually manage these things. So it gives you a buffer. You want that cash buffer, which the money comes out, it goes into this silo, and you take a bit, and then you can manage it. So great question from Phil. I think the answer, as I say, is you want to produce a sustainable income, that is the best way. But realistically, there may be an element of growth in there as well, because don't forget, sometimes those funds will just grow, and therefore you might want to take a bit of profit. Good question.
Good stuff, Damien. Enjoyed it as always. That's the end of the podcast. I suppose it's for us to say the usual stuff at the end, the stuff that they've probably already turned off by now, but we've got to say it. Do please review the podcast. It'd be great if you could hop onto iTunes and tell the world what you think. It helps us go up the iTunes charts. It helps us spread the love and gives Damien a sense of pride and all of that kind of stuff.
Yeah, and it gives us a bigger influence, because one of the things I did this week, actually, which I didn't mention, I went to an awards ceremony, because I was judging on the journalists out there. So who's the best journalist in terms of investing that you read in the national newspapers, which is interesting. I was on a vote. So all these things of influence that we have, because of the amount of people that come and read and listen to what we do, it's important that people support us, because if they don't, then you only get what you had previously. So people love to moan about the city, they love to moan about the people in the industry, but they don't support the things that people are trying to do. So that's not just me. I'll give you a good example before we wrap up. A couple of weeks ago, there was a financial advisor who I lent my support to, actually, in a newsletter. People may have seen it, who wanted to ban cold calling on investments and pensions. And the reason I said it is, one, it was a good cause, but more importantly, I said the reason why you should support that petition was because it encourages people like him who can, if financial advisors can see that a financial advisors influence government policy, they suddenly realise that they're bigger than their industry, they're bigger than themselves, and they can be altruistic and do things that aren't just for gain. And in the autumn statement last week, they announced they're going to look into it and possibly change the rules. So you can make a difference, but you have to support it. So that's a very long-winded way of me saying, go on there, like everything we do, tell everybody about it, and ask Damien Fahy questions on the new video and social media. Make sure you share this stuff. Right, anyway, that was a bit of a rant, I think, but it's over with.
It was. So, get in touch, comment, like, share, and you can influence what's going on in this dodgy old industry of ours.
Yeah, and this podcast, as we've just proven.
Good. If you want to contact Damien, do so. He's got a couple of different ways of contacting him. Podcast at moneytothemasses.com, Damien at moneytothemasses.com, or you can get to him on Twitter, and it's Damien at moneytothemasses with the number 2.
Yeah, and Instagram. I am loving Instagram. I'm hooked on Instagram. If you want to see what I'm doing all day, I now take photos and video of what I'm doing day to day, and you can see what somebody who's trying to change and reform the finance industry actually does. So go and have a look. Anyway, that's it this week.
Bye.
Until next week, bye.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.